In a previous module, we looked at some components of the initial outlay which may be capitalized. This means that the cost of equipment and some other initial development costs may be capitalized. They are not claimed as a tax deduction at the beginning of the project, but instead the cost is apportioned over the life of the asset or the project, and then they are subject to depreciation. In this module, we'll look more closely at depreciation and its effect on cash flows. We'll start with a definition of the term depreciation. It means apportioning the cost of a capital asset over the useful working life of the asset. It's primarily an accounting function. It's designed to match revenue and expenses in a given period of time. The important thing to remember is that depreciation is not a cash flow. It is never included as an incremental cash flow in the calculation of NPV. However, the payment of tax is a cash flow. We therefore need to understand depreciation in order to understand the depreciation tax shield. This means a reduction in tax payable as a result of depreciation. Paying less tax than we otherwise would is an incremental cash inflow, because the reduction of tax is an amount that the firm is better off. Before we continue, we'll look at some terminology that we need to understand. The depreciation itself is the annual reduction in the value of an asset, which is claimed as a tax-deductible expense. Accumulated depreciation is the total depreciation up to this point in time since the asset was purchased. And the book value at any point in time is the cost of the asset less the accumulated depreciation up to that point.